Good afternoon, everyone. Welcome to the second episode of Bilbel Capital's podcast. I'm Matteo Muscat, for those who do not know me, and I am here with Gabriel. And today's topic is going to be risk. So, to start off, Gabriel, the first question which I would like to ask you is um, how do you define risk? What's your definition of risk?
So, risk is things that happen that cause someone to lose a valuable resource. Now, in the case of investing, it would be the things that happen that cause a person to lose money in an investment. But risk depends on two main things. So, it depends partly on the business. So, the risks of the business are that the earnings power go down over time, or that the management misuses those earnings and invests them in places where the return is very low or negative. But then there is also the risk of the individual making the investment in the business. And that would come by misunderstanding the business or by paying too high a price. So that's the way I see it.
Okay. And if you have to look at the risk philosophy at Bilbel Capital, the way we look at risk, how does this align with our long-term investment beliefs?
Well, in general, the risk I'm looking at is defined on the period of time in which the business exists. So, for me to understand the value of a business, I need to understand how much it will earn over time. And once
Okay.
I know how much it will earn over time, then I know how much it's worth today, or at least I have a rough understanding. Now, um, since that's the case, the way I need to measure risk is over the whole over the lifetime of the business, but also um, within the next few years in which I am making the investment, because it is likely that I will not own a business for 10 years or maybe even 5 years. So the risks that are present in the next few years are also very important, even though they may not be very large risks when we look at a 30-year time horizon. So that's the way I see it.
Okay. And in your view, within the context of a fund or a fund manager and investor, but mostly within the culture of a fund, what behaviors, in your view, would signal a healthy risk culture? By
That's
healthy risk culture, I mean someone taking, to put it simply, taking the right amount of risk, so to speak.
right. Okay. So I would say the more undervaluation there is in a company, the more unknowns there can be. So
Okay.
unknowns can create risk. They are not necessarily risk. Since they are unknowns, we cannot know if they are risk or not. But we cannot assume that unknowns are not risk. So that's definitely the case. So it is partly a function of how undervalued the company is already, given the information and the explanations we have today. So if a company I think is worth 10 times as much, but there are a few unknowns which can create risk, then some of that risk might be fine to take. But the way I see it is that I would, so small risks, if they are catastrophic, must be accounted for. So that would be part of the equation of position sizing. So even if something is or happens very rarely, it still must be accounted for if it can create an extreme outcome. For example, with Thesis, there were houses I couldn't really find existential risks, but one of them might have been a war, for example. So a war might have created a catastrophic risk, but it was what many people would say a low probability event, but it still must be accounted for. So it must be looked at in that way. But I would say the proportion of lack of information given depends on how well you can already explain the investment as it is with the information you have. But also, you can deal with more uncertainty the more undervaluation you have.
Okay. And where would you draw the line between calculated risk and speculation?
So calculated risk would be, it would be a part of a thesis which is not yet understood, but the thesis itself is already strong. So let's say I have a very good explanation of why the business will get better over time, but there are some things which are important which I do not yet know, but I know that I do not know them. In that case, that is a risk, but it is a risk that is understandable within the thesis. Now, speculation to me would be taking a decision based on either no explanation at all or a bad explanation. So if
Okay.
I just invested in a company and I said the Japanese, for example, let's say it was a Japanese manufacturing company. If I invested in the company and my thesis was that the Japanese are hardworking, that is not a good explanation as to why this specific business at this specific price is a good investment. So that would be speculation. Another way of speculation is just no explanation at all. So I just buy this Japanese manufacturing business and I just don't even have an explanation of what's happening. So I would categorize speculation in those two ways.
Okay. And with regards to any frameworks which you use to evaluate potential downside scenarios, do you make use of any such frameworks?
Yes, they depend a lot on the business. So what I try to do is I try to simulate different scenarios of the economy or of certain constraints the company might have. And after simulating them, I will try to understand what the biggest risks are there. So when I simulate the scenarios which, in my explanation, are most likely to happen, and I understand those risks, then I can move accordingly. So yeah, I think I found it decently useful to create scenarios because in many ways, when people look at risk and even myself, there tends to be fear that is created in the mind, and that fear is very vague. But when I drill down to specific scenarios or to all the scenarios that could happen, then that fear really goes away, and what I end up with is just an understanding of what might happen and what might not happen. And then from there, I can make rational decisions. So the more specific I can be as to what can happen, even considering very extreme outcomes, as long as I consider them, then I can have a rational approach to move forward with that investment.
Okay. And you've stated that you simulate scenarios. So my next question is there anything in particular which you do to ensure that you are looking at those scenarios or risks which could which would potentially matter the most?
Well, yes, I think partly that comes from trying to create more than one explanation of what's happening. Because then when I
Okay,
have more than one, let's say I have two, it's most of the time I just have one. But I try to create more than one, and the one I create would be better than the previous one. So when I have two explanations of what's happening, then I can test using similar scenarios in, let's say, other countries or in different time periods, where I can disprove one of them. And that way I have the explanation I end up with would have a much stronger base than if I just had one explanation, which wasn't really digged deep to check what errors there were in it.
okay. And in relation to risks, what are some ways in which an original thesis can break? Could you give us some possible examples?
Yeah, so the more specific the thesis is, the easier it is to identify when it's broken. So that is very useful. At least it is for me. So when I see that a thesis is vague, then there is firstly error in the thesis, because if it's vague, then it's a sign that I have not understood the real causal effect in the system. But where was I? Apart from that, can you rephrase your question again, because I lost the
Uh,
chain.
the question was, in relation to risk, what are ways in which a thesis can potentially break or change? As in, the level of risk can potentially evolve, right?
Yes,
It could
yes,
be
yes,
that
yes, yes.
something potentially happens which increases or decreases what you think was the level of risk within a company. Is that possible?
Yes, that is definitely possible. So I try to, so a very, well, a thesis is a chain of statements that describe cause and effect in a business. So when I know all the statements, then when I receive information that invalidates one of those statements, then the whole thesis has to change. So an idea would be, for example, if I have a thesis that CareCloud will do well because they buy companies at one times revenue or two times revenue, let's say between a one and two times revenue. And after cutting costs, they make a 30% return. Then my thesis would be partially invalidated if CareCloud went and bought a company at four times revenue, without them showing that they can decrease costs more than they did in the past. Because then if they can, then I have to adjust the thesis, which might remain roughly the same. But if the purchase price went from two times revenue to four times revenue, then the return on capital is much lower. And then the valuation, if I think that that will keep on happening, has to change quite drastically. So let's say the purchase price is twice as much as I thought it was, and it will keep being that way. Then the growth rate might be half of what it was, which might also mean that the company is worth half of what it is today, or of what I think it was with the previous thesis.
Okay.
So yeah, it is very company dependent, but the more specific it is, the faster I can error correct the thesis, because it is very easy to spot when it breaks.
Obviously, this would also depend on new information coming out.
Yes.
So my next question would be is, how often do you revisit your thesis to monitor any potential changes potentially?
So I try to see all the information that comes out that's relative to the company.
Okay.
And well, most of the time that information might not be very useful or very important, but sometimes it is. So I try to look at all the information that's out. Spe More specifically, the most important information would be the company information, so the filings that come out. But then it would also be certain information I can get which is not obvious but also public. So I would say I try to find new information every week, although I don't
Okay.
always find information every week. But basically, the way I see how quickly I need to find information, it would depend on how quickly a business can change based on new information. So
Okay.
basically,
Okay.
let's say I own Coca-Cola. The chances that the thesis of Coca-Cola changes in the next year is very low because the business is very stable. There is not much that can hurt it, but there's not much that can change it much in its favor either. But the smaller the company, the more management has power in changing the direction of the company, and also the more the business can be hurt or can grow with a few a few variables going in their favor or against their favor. So with smaller companies, I have to be more careful.
Okay. And now, moving on. Um, do you believe that a proper risk assessment can unlock hidden opportunities?
Yes, mostly in position sizing. So normally when I look at something that looks strange, I default to pattern recognition, which is saw many similar strange things and they turned out to be bad. And that means that if I make an investment, I will make it a very, very small position because that's what I have recognized as patterns in the past and that's what I will do. But that is actually not a correct way to go about things. So the correct way to go about things would be to try to find as much information as possible that is relevant to creating an explanation of what's happening. And then when I when I start creating the explanation of what's happening, the decision must be made based on that explanation and not based on my opinion, my belief, or how I feel. So this has, particularly with races, this has been the reason why I made races a big position. Because when I asked many people, they told me that Turkey is risky and they had pattern recognized so many opportunities that had failed that were roughly similar to races. But the rational thing to do at that time was to try to really understand what was happening and to really understand the risks based on the most fundamental ideas that exist. So the most fundamental idea I had at the time was that a business is worth the sum of cash flows it creates over time, and that is still a fundamental idea. And therefore, if I could have a good explanation as to why the rents would increase over time, and I knew roughly what those rents would be, then the risk of owning those properties at 1/10 the value was so low that the position size was rational to be very high. So pattern recognition wouldn't have got me there. It would have been irrational to just put it under a bucket which says this is an emerging market company or any other bad explanation. And it was rational to dig down to the unit economics as to what will happen to the business and then judge just based on that.
Can you elaborate more on this point in relation to Intellego technologies? Because I know that some people thought it was a bad investment due to some news which was coming out. Some people are still putting up news about it being a fraud and about issues relating to their past auditors and change in auditors and so on. So could you elaborate on how important a proper risk assessment was in the case of Intellego Technologies to ensure that an opportunity was not missed?
Yes, that was an interesting one. So at the time, Intellego was growing a lot, and so this was July of 2024. So Intellego was growing a lot, and I saw many reasons why it would keep growing a lot. But the stock was very cheap, so it was at around 5 times earnings based on the earnings that year, which I knew were very low relative to how much they could be. But then the overwhelming um, thing I saw from other investors was that this was a fraud. So immediately my brain reacts and says, okay, I should not be in this stock. But the rational thing to do is to drill down and see exactly what is happening and to value each allegation or each thing that happened that has created the explanation that this company is a fraud. So one of them is low cash flows. So I thought that that was not a problem at all. So basically they gave very favorable payment terms, but that is not a sign of fraud. So that allegation was striked off in my head. Then it was the the problem with the auditor, but I realized that they changed their auditor to Deloitte at the time. So that was also checked off. And well, they had to pay a fine, which was related to Daro, which I thought wasn't a big problem either. And basically, there were many things that together have created frauds in the past. But just assuming that it is the same with Intellego is incorrect because there were many things that could easily disprove that Intellego was actually a fraud. So the idea of a fraud, so this is the way I thought at the time. So the most important fundamental idea is what is actually a fraud. So a fraud is a way to make money that is illegal, and you do this by taking out more money than you are deserved legally, and you do that by taking money from other shareholders and you take it yourself. Now, if that is what a fraud is, then Clay Swindle, the CEO, would not be buying shares whenever he could at the time, because the idea of a fraud is to take money out rather than putting money in. So that was already a sign. Apart from that, Claes was very open to, well, to actually showing what was happening behind the scenes if someone asked for it, which frauds do not do, because that would show that it is actually a fraud. And frauds would do whatever they can to have auditors that would help them commit their fraud. So they wouldn't change an auditor from an auditor that was smaller to an auditor that had more reputation. Apart from that, they would not they would do whatever they can to not be susceptible to due diligence checks. But Intellego was due diligence by Nordea Bank and by several other companies. So that was also a factor that did not make much sense when you would think it is a fraud. So after all those things, the only explanation I had was that it is not a fraud, and that at the time the company was growing a lot, and Clay Swindle might not have communicated the direction of the business as clearly as people would have expected. And that explanation has survived so much criticism in my head, and the explanation that it is a fraud has survived almost no criticism. And when I see those two together, I try to disprove one of them, and the one that got disproved is that it is a fraud, which it is not.
Okay. Now, moving forward, um, do you adapt risk strategies across market cycles? And if yes, how?
So by market cycles, I think many people have different definitions. So it would be very hard to give an exact answer, but in general, when the economy or the economy relevant to the business is doing badly, then there must be more focus on how well they can survive that those years where the economy relative to the business is bad. Because it is likely that earnings will go down, and if earnings will go down and earnings are low enough, then they might start losing money. So there are periods where companies that take more risk do better, but eventually do worse because when they hit a downturn, they go bankrupt or they actually lose out on money. So I think it is very hard to predict the economy in general because there are so many variables and so many important variables. And it is also less important than actually understanding the internal economics of the business, which are more important and which also have less variables. So if I have three variables that I can really understand, then my error as a whole will be much smaller than if there are 20 variables I must understand and I have error in each one. So that's basically the way I see it. But it is useful if someone has, or if I have a good insight about the industry or the economy that's going to affect the business. If I do think there's going to be a downturn, then I have to have a very clear explanation as to why they will do well even in a downturn, or at least do better than their competitors and survive that period.
Okay. Now, um, could you give, if applicable, some examples of how geopolitical or regulatory or environmental risks fit in your thesis, perhaps by giving an example in relation to a particular company?
Yeah, so I would say most of the time, those variables do have an effect, but their effect is not large enough to fit into the most important things that must be understood.
Okay.
But when the conditions are either extreme or could be extreme, then they must be accounted for as well. So let's say with races, I did I had to have a clear thesis as to why the geopolitical scenario and the inflation will not hurt the business because I could see that it was actually hurting the business at that period of time. So I knew for a fact that it had an effect, but what I failed to realize in the beginning, which I then realized after, which is why I made the investment, was that this was something temporary to the business. So it was something relatively permanent to the country. But the effects were temporary to the business.
The
So
business. Okay.
yes. So I think a lot in terms of permanence and non-permanence, and well, nothing really is permanent, and nothing really is well. Temporary is also a vague word, so I would try to think in terms of a few years at a time. But but yes, I would try to understand uh, if uh, if these extreme risks or if these extreme conditions can create large effects in the company and how long those effects will last.
Okay. Now, um, I have the last question from my side. In relation to risks, um, what have you learned from potentially past investment mistakes or from past investments in general, not necessarily mistakes, in relation to risk assessment?
That's probably a hard one. Um, I think trying to. So one mistake I did was there was a company I bought into, and I didn't have a very good explanation as to the how the business will do over time. But I had an explanation about the management, which did not um, was not very causal. So what I mean is that this management team had a business before, and it was very successful. Then they entered this business, and my explanation was, since they were very successful in this business, and this business is similar enough to the previous business such that the skills overlap, then they should always be they should also do well in this business. But looking back, that alone is not a very strong explanation because the causal effect, there is some causal effect. So if someone has done something very well in the past and now he's doing something similar now, then it's reasonable to assume that he will do reasonably well. But between reasonably well and very well, there's a very big difference. And that explanation alone is not enough. So that was a mistake I did. So I would say misunderstanding how causal something is and trying to find justifications for why something maps to another even though it doesn't. But the way I try to mitigate that is to have the explanation be as specific as possible. So looking back, that explanation wasn't very specific. It was just, okay, they did quite well with this business. This is similar, so they should also do well. But that's not very causal. It doesn't drill down into many important things. So that was one of the lessons I learned.
Okay, perfect. So those were all the questions planned for today. I would like to thank all those who are listening to us today. And from our side, we will be with you with another podcast next month. If you have any ideas or suggestions relating to topics which you would like us to tackle or discuss, feel free to let us know. You can message me directly on X or you can send us an email. In addition, if you have any further questions relating to today's topic, you can either leave your questions in the comments or you can contact us directly either on X or on LinkedIn or via email. From our side, so that is all for today. Thank you all so much and wish you a great day or night ahead. Thank you very much. Thank you.
Thank you, guys.